All right. Good morning, everyone. Thanks for joining in. My name is Sumit, and I'm co-founder of Truemind Capital Services. So there is a growing interest in investing globally, given that there has been advancement in technology and also progress in regulatory environment. So it has opened door for investment opportunities to take advantage of investment opportunities globally and to shed light on what are the possible investment opportunities, what is the landscape that we can look at. We have here today with us Nilesh Shetty. He's a fund manager with Quantum Mutual Fund. He brings with him 17 years of rich experience. He's also a CFA charter holder and has also other qualifications. So, Nilesh, thanks for joining us. Over to you. You can take forward.
Thank you so much, Sumit. It's a pleasure to come and sort of give this presentation on your platform. I know the reasons for interest in global investing, the reasons that you laid out were regulatory enhancements and some other reasons. But I think the number one reason people want to invest now is how they've done over the last 5 years versus EMs and India. I think that is what is drawing attention to global investing and whether you should have that in your portfolio. But so let me try and lay an overview of where we think globally, market-wise as well as style-wise, we think where markets are heading. And of course, after that, I'll just give you an overview of what are the key positives of investing in global markets as well as risks of investing. So let me start by giving an overview of a 20-year view. Some reason I'm not able to move this. Yeah. Okay. Right. So right, over the last 20 years, India has been the place to be invested. You compare India with other emerging markets, global markets, it has done a lot better. And so if you are an Indian and been exposed to the Indian market, it has been one of the best stories to be invested in. This is a 20-year view. Of course, if you break it up, things look slightly different. But over a long period of time, India has been a fantastic place to stay invested in. So I want to start off with that, saying that even though this presentation is a presentation on global asset allocation, India remains sort of one of the top places to be invested in if you're looking to expose yourself to equity markets. Okay. If you try to break up that performance in two cycles, right? One was the cycle of 2000 to 2010. Now, if you remember, 2003 to 2007 was a global expansion in GDP. And of course, BRIC was a term which was coined in that era. So it was clearly an emerging market dominated performance. And emerging markets did a lot better than developed markets. In fact, the problems that erupted in 2008 was primarily a developed market problem when the US subprime crisis sort of collapsed. And that created problems primarily in the developed world, but what it also did was it impacted flows into emerging markets. But even adjusted for that, it was an era dominated by emerging markets. So a decade ago, nobody even posed this argument that whether you should have developed markets in your portfolio because emerging markets were doing so much better. And of course, Indian equities was far ahead of most other markets. If you move to the next decade, the decade after that, things look slightly different. And it's been an era of developed markets. And this is especially this played out over the last 5 years as the FANG stocks started becoming a major part of the indices and sort of technology disruption erupted. And a lot of money flew back to developed markets. And of course, emerging markets went through their own problems. India, of course, growth stagnated since 2013 onwards. China, of course, has its own problems now with the regulatory crackdown on different businesses as well as debt issues in that economy. Russia, of course, has always been a very volatile market, commodity driven. Brazil, again, has its own problems, especially on the currency side, as well as political stability and high inflation. So emerging markets actually went out of the window over the last 5 years. And it was primarily whether you should be investing in DMs and what developed markets or companies that you should expose to. It was also an era of FANGs, where all these big technology majors came out of the West and their performance essentially pulled up a performance of indices like the Dow and Nasdaq. So I know 20 years, it looks like EMs have done a lot better, but it really goes through cycles. And the cycle of 2001 to 2010 was dominated by EMs, including India. And the last decade, especially the last 5 years, has been dominated by DMs. And this question, actually, I used to do presentations 5 years ago. Nobody used to ask me about exposure to developed markets. It is because of the phenomenal performance over the last 5 years that now you're seeing increasing questions being asked about should we invest in developed markets. And of course, markets, so the way mutual fund business works, they will create products for investors based on demand. And if there is demand for people wanting to invest in developed markets, you saw a lot of local mutual funds offering products, as well as the regulators sort of creating an enabling environment for people to be able to expose themselves to developed markets. This slide I specifically put in because if people who know about quantum know that we come from a value investing pedigree. Our flagship fund has been the value fund, and the portfolio team essentially comes from a value investing pedigree. And I having a discussion with Sumit also tells me that Truemind has a value investing pedigree. And again, styles also go through cycles, and the value style essentially dominated the decade from 2000 to 2010. Now, value typically tends to buy sort of solid companies with hard cash flows, assets backing those cash flows. So in a nutshell, they would rather give value to the current cash flows and the business of the company rather than potential cash flows and probability that this company 10 years later could be 10x of the current size. By and large, because there was a global GDP expansion in 2003 to 2007, value did a lot better, as you saw a lot of commodities, old economy stocks doing a lot better, while technology and other space, including consumer staples, actually suffered in that era or underperformed in that era. So value investing actually was one of the styles to stay exposed in 2000 to 2010. As you come to the next decade, of course, the FANGs essentially dominated, and it was the growth stocks which did really well, especially in the last 5 years. Last 5 years, the performance between value and growth has diverged so much. And I know Quantum gets a lot of questions of whether value investing works. I'm assuming even Truemind gets a lot of questions of whether getting exposed to value investing is the correct strategy. But again, it is cycles, and markets go through cycles. You had a decade of value doing well, and the last decade was essentially growth doing a lot better. And there is no reason to believe that the value style will not come back. If the underlying factors which support value, including global GDP expansion and old economy stocks getting back to their long-term growth rates, if that plays out, then you expect value to do well. Right. So based on the sort of charts that I've laid out before this, if you were to sort of break it up into decadal cycles, so 2000 to 2010 was EMs and value. 2011 to 2020 was DMs and growth. So if you were to make a tactical allocation of 2021 to 30, and again, this is a hypothesis. This is not, I'm not saying it is definitely going to happen, but at least post-COVID, it looks like, again, it could be the era of EMs, and again, it could be the era of value. If you were to take a tactical allocation of where you want to stay exposed to, perhaps these two buckets would offer better returns than what you've seen in the previous decade. I think that could be a logical conclusion if you're planning your asset allocation. Again, this is hypothetical. I don't know if this is actually going to happen. It just the way the markets have played out in cycles tell me the next decade could be for EMs as well as for value. Coming back to the topic of why invest in global markets. Again, the primary reason of why you should be investing in global markets or markets that are not your home country is diversification. You get diversification across geography and across styles. Because the regulatory framework in the developed markets is a lot more advanced, you might actually get exposure to products which are not even there in your home markets. So the number one reason that you should be investing in global markets is not for return. You should primarily be invested in global markets for diversification, because hopefully if the home market, which is your core portfolio, does not do that well, you might, the other part of the portfolio gives you some sort of hedge and improves the performance overall. The other reason is of course, no country has sort of a patent on best managed companies in the world. These companies are spread out across the world, and you can get access to them if you start moving out of your home market. Again, we have to be careful because you're not in these markets, analyzing these companies become very tough. So if you ask me why, say, Tata Consumer is not doing well, or say Infosys is not doing well, it is easy for me to explain the reasons. But because these global companies operate in different markets and different geographies, and your visibility sitting from where you are is limited, you have to be careful of how you take exposure in these companies. I'd rather stick to quality and known names in the bucket if you're planning to invest there, rather than getting yourselves exposed to smaller companies where visibility is very limited. The other big reason, again, the reason why I know a lot of people have invested in especially in DMs, is because they have a child who's early on in the education cycle, and they know for sure 15 years later or 12 years later, they will be sending him to the US or other developed countries for his further education, and they want to get that dollar hedge upfront. So getting exposure or getting investing in global markets, especially the US, not only gives you access to some of the best companies in the world, but it also gives you a dollar return, which is hedged for currency depreciation. So in that sense, it also protects your purchasing power in some sense if you have dollar expenses to meet 12 to 15 years later. Risks, of course, is, like I said, you need to invest in global markets, assuming that you want to diversify, not necessarily because of risk. You may end up compounding your risk in your portfolio. In the end, equity markets move in tandem, especially in periods like, say, 2008, when global markets collapsed, or in even 2020, when, because of the COVID scare, you had a global sell-off. You want to expose to yourself to equity markets, which are very different from your home markets or where you primarily invest in, to give you some sort of diversification. If you're not doing that, you invest in markets which are very similar to you, might end up compounding the risk in your portfolio and not necessarily diversifying away the risks that you have. The other big risk that you need to be careful of, especially if you're investing from India, is this entire thing of investing abroad is highly regulator dependent. India traditionally has run into forex problems. And if crude were to go substantially higher, FIs were to pull out, and forex reserves start depleting, I expect the regulator to clamp down on all this money which is going abroad. So whatever plans you have of investing regularly, it might just be blown out of the window if the regulator comes and says that no, you cannot invest in overseas markets. The other is, of course, transaction costs and taxation. Typically, developed market products tend to be a lot more lower cost, especially on the passive side. But since you will have to purchase it through brokers and other means, sometimes transaction costs can be very, very high. And you need to focus on that before you're investing in global markets. Some of the products inherently tend to have a lot more expense ratios built into them. Yeah, there is taxation. Even though you might be investing in equity, the taxation in India is akin to a debt fund. So you will be taxed. Long-term capital gains will be after 3 years with indexation benefits, and less than 3 years will be short-term capital gains tax. So the taxation is not that favorable, even if you're exposing yourself to equity markets globally, and it's taxed as a debt product in India. In terms of how much allocation should you be doing in global markets, at least our advice is not more than 10 and 15% of your overall equity allocation. Precisely because of the understanding of what is happening in these companies and these geographies can be limited, and by and large, you really need to focus on diversification and not necessarily on returns. The entire objective of adding that layer to your equity portfolio is to diversify and get some risk control in your portfolio. So hopefully, when your home portfolio is not doing well, you invest globally, and that portfolio does a lot better for you and reduces some of the downside risk in your portfolio. So at least our internal advice has always been to clients not to invest more than 10-15% in global markets. Majority of the portfolio should be, if you're an Indian, then in your own markets. And again, our overall belief is equity market performance tends to follow GDP growth rates. And if emerging markets, in theory, will continue to grow a lot faster than developed markets, by and large, emerging market equity performance should be a lot better. Within that, we expect India to be one of the fastest growing economies over the next 15-20 years. So there's no reason not to stay or have a large exposure to Indian markets if you're a long-term equity investor. That sort of was my presentation. I think we can get into Q&A. So if you want to, unless you have some specific points you want to ask, you can sort of straight away get into Q&A.
Yeah. Thank you, Nilesh, for the very informative session till now. And, before we jump into these questions, a specific question on taking exposure in the investment opportunities related to growth of China economy. That I would like to have your views on. How do you perceive? Because we know that China ultimately, we expect it to become one of the major superpowers, even overtaking USA at some point in time. So shouldn't having some exposure to Chinese equity also would make sense?
Yeah, it's an interesting time when you ask that question. I know a year ago, the answer would have been obviously yes, it's a fantastic growth story. Things get done in China very quickly. Look at the infrastructure that they build. But one of the big problems of investing in China is the political system. In the end, it is run by the whims and fancies of one party. You saw what happened a year ago. In around October of 2020, they suddenly decided certain businesses are not businesses that you should be promoting, and they went after them, including on the technology side, on the education side, on the gaming side. And what you saw then was a rush of money out of China and into India. So actually, if you look at FII flows from October 2020 to say September 2021, India got flows of almost $28 billion. And most of that was primarily reallocation played away from China. My simple rule is, if you were to look at investing, especially if you're an Indian exposed to Indian emerging markets, again, which has regulatory challenges, one of the first criteria that you should have is you should be investing in countries where the rule of law is very, very strong and the governments are accountable. That necessarily gives you a decent hedge in your portfolio. Given that these two are slightly fuzzy in China, I would be very, very careful of investing in that market. The other big reason is, of course, the data in China is not particularly reliable. You really don't know what is happening. And you have what you're seeing over the last few months, very large real estate players suddenly going bust. It's really difficult to invest in such markets where you don't trust the underlying data, including data on GDP growth and the kind of consumption numbers that are coming. So my advice, you might have a very, very small allocation if you want to, but my advice is, especially if you're an investor already exposed to an emerging market like India, perhaps look at developed markets and not necessarily look at other emerging markets.
Very well put out, Nilesh. But I would rather say that, totally agree that China exposure to China equity should not be too much. But, if one has to look at, the Asian economies like Taiwan, Singapore, so clubbing China, Singapore, Taiwan, or maybe Hong Kong into it, a basket of, investment in these economies, that probably can also help us diversify. And what, you mentioned about the disruption that regulators caused in China, the government caused with respect to technology companies as well. I also see it in a way that they are setting ground for further growth where their common prosperity agenda going forward. And if they have to grow, if they have to overtake US, and if the economy is going to grow well, then as you mentioned earlier, a good GDP growth rate will also drive business growth rate. So that's how I think some exposure to China may be good, but overexposure can harm us. So yes, I think we can go ahead and answer these questions. And anyone in the participant, if you have any questions, please put that in the chat box and we'll take it in the session itself.
Okay, so should I take the questions one by one?
Sure.
Yeah. So the first question is how to identify good investment opportunities globally. As I stated in my presentation, the number one reason that you should be investing outside of your home markets is diversification. not necessarily look at returns. What you have to look at is when you add that investment to your portfolio, how does a portfolio behave? Does it compound risk, or does it reduce risk and give you diversification benefits? If you lay down that criteria and you look at where you are in your home market, especially if you're invested in India, India is an emerging market with regulators or a rule of law which can be slightly fuzzy, but it's a fast-growing market. You want to invest in markets which are very opposite of that. You want to invest in markets where the rule of law is very, very strong and the regulatory environment is very, very strong. And of course, gives you access to good companies. So again, the advice that I'm giving you is primarily driven by diversification needs, not necessarily return, where I think the best returns will come through. But I think for an Indian investor, if you want to invest globally, then you have to focus on developed markets. I think markets like the US and Europe, where companies, the environment of operating for companies is firmly based on rule of law, perhaps will give you much better diversification benefits in your portfolio than investing in other emerging markets if you're an Indian investor. So that's sort of my advice on identifying good investment opportunities globally. Again, it is not coming from a return perspective, where I think the returns for these markets will be the best. It is coming from what happens when you add them to the portfolio, whether it compounds the risk or gives you diversification benefits. And for an Indian investor, I think developed markets give you that diversification benefits more than investing in other emerging markets. The second question, which is there, is should one consider passive or actively managed funds for international investing? Again, if you have RIAs like Truemind who can analyze and sift through data and pick up funds and suggest, no, I think this is a fund for you, then you can look at sort of actively managed funds. But if you're an investor who doesn't have that kind of analysis or data with you, and if you then just want to access developed markets at low cost, then perhaps passive is the best way to go for you. But if you have someone advising you and guiding you and then sifting through data and telling you these are the funds for you, and then looking at the portfolio and telling you that when you add these funds, this is how the portfolio will behave, perhaps then you might want to look at actively managed funds. And I'm sure Truemind has selected a bouquet of funds for its clients on how to invest in. What is the best route to take to exposure in global equities? Again, so I'm assuming it's coming from whether direct investing or whether you should get exposed to funds. Again, if you have someone to guide you, like you have in case of Truemind, then you can always go by their advice and listen to the funds that they are saying you should be investing in, because I'm assuming it is backed by the research that they're doing. Otherwise, I think simple passive exposure works best. Direct investing, like I said, you have to be really careful unless you have the capability to analyze these companies who operate across multiple geographies and have multiple business lines. I'm not sure direct investing or picking stocks works that very well. You might catch a cycle right and might do really well. But by and large, I think sticking through funds, either passive or active, is a better route to take exposure to global equities than direct investing.
So Nilesh, even I would say on this, I would like to add on this. So there is also an issue of taxation when you invest in direct equities globally. Going through mutual fund route, minimizes your taxes and provides you better transparent liquidity. That's correct. That's correct.
And currently, what are the major global risks that can affect equity investment? The number one risk, of course, is where interest rates are headed and what the Fed intends to do. Inflation has surprised on the upside. Equities tend to move in inverse relation to fixed income rates. So interest rates are heading up, cost of capital moves up, discounting of future cash flows, the value becomes lower, and in theory, equity prices should head lower. By and large, you've had, especially after the Lehman bust, almost now 13, 14 years of low interest rates, very close to zero interest rates in developed countries. That has kept equity prices high. If that were to reverse, again, we are slightly skeptical of central banking behavior. They tend to favor growth more than inflation concerns. And given a lot of the inflation is because of supply side bottlenecks, you're still not seeing central bankers rush to raise rates. But if inflation continues to remain high, central bankers reverse their interest rates view and suddenly decide we need to quickly raise interest rates, you should expect equity markets to correct. In that environment, again, if it's a demand-led inflation, I still expect stock markets to do relatively okay, which we saw in 2003 to 2007 cycle, where interest rates, even though they were heading higher, equity markets did really well. But if it's an issue where growth is not coming through and inflation is still very high, you might see a significant correction. So if you are in an environment where there's stagflation, you should expect a significant correction in equity markets. That really remains sort of the only major risk on the horizon right now. The other risk of pandemic and others, I think by and large, we are getting to a fag end of the pandemic, despite Omicron sort of surging now in India. But most countries, by and large, are fully vaccinated or are getting there. And I think they are getting to the view that you have to live with this virus and you have to get on with life. And you're seeing that signs in the UK, where they're now not making mask compulsory and opening up offices. And as long as hospitalization level remain low, I think pandemic is not an issue anymore. So that's sort of the only major risk that I see: high inflation, which might trigger rise in interest rates and might trigger a correction in global equity markets.
And Nilesh, what do you think about the risk which could be geopolitical tussles that happening in Ukraine or maybe with China? So do you think these risks can grow significantly, which can impact investments?
Yeah, I mean, by and large, they tend to be very local skirmishes, and I don't expect there to be a major global conflict that might come through. So if that happens, then you might have a sentimental correction for a few weeks or months, but by and large, markets tend to ignore that. You saw that slightly when there was a Crimea issue with Russia. But by and large, as long as earnings continue to move higher and global demand remains robust, corrections driven by such events could be sentimental, but it will get back to its long-term trajectory very quickly.
Yeah, thanks.
What emerging investors should consider while investing for diversifications? Like I said, I mean, even in my first answer, you want to invest in countries which are very different from where your home market is or where your majority of the money is invested. If you are an investor exposed to India, and you want, which is an emerging market where regulatory environment can be slightly fuzzy, you want the opposite of that. You want to invest in countries or companies where we're operating in a market where the rule of law is very, very strong. The opportunity to experiment and thrive is very easy for them, and ease of doing business is great. So in that sense, perhaps you want to invest in developed markets more rather than other emerging markets. And again, the key is whether it is adding diversification benefits to your portfolio and not necessarily compounding the risk. You don't want to add markets or portfolios to your existing portfolio, which again moves in sync and defeats the entire purpose of investing in non-home markets. What are the advantages and disadvantages of currency diversification and taxation while considering global investment opportunities? Like I said, I mean, especially if you're an Indian investor and if your majority of your money is in India, given the inflation differential, you should expect the currency to depreciate against the dollar. If you have dollar commitments to meet, then investing in dollar assets perhaps makes better sense. See, over the long term, I expect the returns generated from equity markets, even dollar returns, to be superior to the dollar returns generated by developed markets. But just as a hedge, in times where currencies can be widely fluctuating, that exposure to developed market dollar assets gives you that additional comfort. So in that sense, that is what you should be focusing on when you're investing in global markets. You don't want to India is a net commodity importer. And by and large, when the commodities move higher, the currency comes under slight bit of pressure if there are no strong FII flows. You don't want to invest in countries with similar traits. So South Africa, even China in some sense is a large commodity importer. You want to be careful investing in such markets where commodity inflation tends to have an impact on their domestic consumption. China, of course, is a different animal because the currency is highly controlled, doesn't reflect that. But you want to avoid countries which are large commodity importers and run a current account deficit, because it will not give you diversification benefits. Taxation, of course, as I said, investing globally, they are taxed as debt funds. And your short-term capital gains actually last for 3 years and will be taxed at your slab rate. And long-term capital gains gets triggered after 3 years and be taxed at 20% with the indexation benefits.
Thank you, Nilesh, for answering all these questions. It has been an enlightening session. Now I'm inviting questions from the participants. If you have any questions, please put them in the chat box. Nilesh, we have first question coming from Mr. Oberoi. What's your views on stocks like Facebook, Google, Apple? Should one consider to invest in the mentioned stocks in current market scenario?
Yeah, like I said, last 5 years, they have, especially just before the COVID rally started, they were the ones dominating returns. And in fact, some of the reasons why developed markets have done so well is because it has been a very, very concentrated rally driven by these stocks. My only concern, again, these are industry leaders, create moat in their businesses and dominate their individual businesses. My only concern is where regulations are heading and what regulators are thinking about these businesses. Because they are so dominant in their space, there is a view that they should be broken up and there should be some limits placed on the way they're doing businesses. And there has been some data to prove that they've abused their power in their respective businesses. In that environment, perhaps they might not give you the kind of returns that they've done historically. Again, these are fantastic businesses to own, but I just be careful in terms of what kind of exposure you have in these businesses. Just because the way the regulations are unfolding in Europe as well as in US, there is increased clamor that these companies have abused their dominant position in their market space, and you might see some regulatory action against these businesses, and the stocks will start reflecting that, where operating environment for them would be a lot more difficult in the future than it was, say, between 2015 to 2020.
So I would like to add one more point into this query. A lot of these stocks also benefited from low interest rate environment. So in case interest rates will increase, then any narrative which is currently set in and not going according to what people expect, any deviation can bring in a sharp correction in these stocks, like we have seen in Netflix yesterday. So the stock crashed 20% in a span of a few minutes, a few hours, just because the numbers that they were expecting were not in line, and also the talks are going on in increasing the interest rates globally. Please put your questions in the chat box. All right, so we have another question from Anand. He's asking, some exotic global funds have been launched in India. Are these advisable for Indians, or should one stick to diversified US-based funds?
I know. See, the way the mutual fund industry works is they cannot launch a product, or most of them, they have to create some differentiation in the products that they launch. Right? So if there is already a simple product out there, they would want to tinker with that and do something to get eyeballs. And they would create products which doesn't necessarily enhance returns or reduce risk. So at least my advice is to stick to simple products, products that you understand. I would be very careful of investing in exotic products, because the risk return payoff is not that clear in some of these products. And when you add them to the portfolio, I'm not really sure whether they add diversification benefits or compound the risks in your portfolio. So that's sort of my view personally. I come from a value investing background which focuses on risk first. That advice comes from there. But if you can understand these products and think they add diversification benefits and can enhance overall return in your portfolio, then you might want to look at it. I personally won't.
We have next question from Rosa. Can you tell us a little about the climate change stocks and investments in them?
Yeah. So people who don't know about quantum, we also manage a large offshore portfolio, primarily of pensions and endowments from the developed world. And somewhere around 2014, we realized this ESG is essentially going to become mainstream. A lot of these pensions have put very strict mandates on their investments and want most of their companies to be ESG compliant, as well as have set carbon emission targets for their portfolios. And of course, we ourselves seeded a team in 2014 and created our own database to rank these companies, but it is here to stay. It is not going to disappear. They dominate the capital landscape of global investing. And you might have a different view, especially if you're an investor in emerging markets, saying because where they are in their economic life cycle, perhaps ESG is not a consideration that they should be focused on right now. But given where the capital is, given where the biggest capital allocators, what they're thinking, I expect more and more money to go in that space, and I expect more and more money to move away from businesses which people perceive to be environmentally unfriendly. Having said that, there is also a bubble environment in certain pockets, especially on the renewable energy side, on the electric vehicle side. You look at the data on sort of market share of ICE engines versus electric vehicle, the market share has barely moved, but the market cap has already moved, and it's already factoring numbers that these companies could potentially deliver 10 years later. So there is a underlying theme where I expect more and more capital to move there, but I'm very, very careful of valuations in that bucket. My simple rule of thumb is if you just invest in companies which are very well governed, I expect most of these managements to automatically focus on the ENS parts. If you get the G right, I expect these managements to focus on ENS automatically in their businesses, because that is where the world is headed. So if you get very well governed companies at valuations that you think are attractive, I think that would make much better investment case right now than just picking a theme and then investing on them, because I already think valuations are very expensive in those markets.
Yes, you very well. I agree with what you're saying. There's been a huge flow of money towards ESG themes, and even ESG landscape is also not well defined right now. So there has to be, standardization of ESG landscape, overall investment scenario, and then obviously the money which has been flowing so rapidly in this theme has caused prices to go up significantly than what could be perceived from a value investor perspective, reasonable enough to invest. We have next question from Mr. Oberoi. If the current rise in the market is backed by proper valuations, or we can see sudden crash going forward?
I mean, genuinely demand is surprised after the unlock happened. And if you look at the earnings estimate landscape in India from 2013 to 2020, whatever estimate analysts were doing for future earnings, you see this graph, it is just sliding lower. The earnings just never came through. And surprisingly, it was after COVID that when expectations were very, very low, analysts are forced to upgrade numbers every quarter. And you are seeing it as, and this is globally, where earnings are surprised on the upside for most large economies. Again, there is some fundamental basis to that, where because you're in economic expansion right now, you are seeing equity markets do well, but it is also backed by a lot of liquidity. Because after COVID, there was a lot of money pumped in, a lot of handouts, especially in the developed world, and interest rates were very, very low. That has flowed into assets globally, which has risen, which has sort of allowed equity markets to move a lot higher than perhaps what is justified by the underlying earnings. India is slightly a different case compared to other markets, where perhaps you might want to be a bit more careful. Because India was in a down cycle for almost 7 years, there is an upcycle due. Perhaps COVID deferred that, but India is on a cusp of an upcycle where you could have 4 or 5 years of GDP, very strong GDP growth, which might continue to surprise on the earnings. But equity returns might be a lot more tempered. What you've seen in the last sort of 18, 24 months, your expectations of over the next 12, 18, 24 months should be a lot lower, because you have to give time for the earnings to catch up to the valuation benchmark that is set. So in that sense, a crash can only happen where there is some significant dislocation in the world, where suddenly inflation is out of control, central bankers are racing to try and contain inflation. That might trigger a crash. But by and large, you could be heading into a period of subdued returns for equities. Again, they might be a lot better than alternates around you, including fixed deposits and real estate. But returns, I personally think it could be high single digits CAGR over the next couple of years till sort of earnings catch up to valuations, and then you might again see normalized returns coming back.
Exactly. Another question from Hardik. Lump sum versus SIP in global funds, which one is better, considering US market volatility?
Yeah, so I personally am not good at timing markets. I am focused on my allocation plan. I would always suggest SIP over lump sum. But if you have someone who can take tactical allocation calls, I think Truemind does that, where they look at valuations and bond yields and then decide, I think now is a good time to invest. If you have someone guiding you like Truemind, then perhaps if they were to suggest lump sum at any point in time, then you might want to follow that. But by and large, otherwise, SIP is always a better route to go compared to lump sum, because timing markets can be very, very tricky. It is not that easy. Nobody knew, especially if you ask me in March 2020, our concern was what is going to happen on consumer discretionary spend, given the way lockdowns have been imposed and incomes were going to get hit. Nobody knew at that point in time you're going to get one of the best equity rallies of all time over the next 18 months. All we knew was valuations were cheap, and hence we allocated a lot of money to equities. But the kind of returns that came through was not that easy to predict. So in that sense, SIP always is a better route to take, unless like you have someone who's looking at valuations and guiding you about making tactical allocations.
We have another question from Mr. Oberoi. As you discussed about allocation, ESG funds are categorized under thematic funds. So do you suggest to have thematic funds in an individual portfolio? If yes, then what would be the percentage allocation?
Yeah, I mean, there are themes like allocation to certain specific sector, which I'll be careful of. I really tough to take a call on sectoral funds. But then ESG, in the end, is a diversified equity portfolio. It is not linked to any particular sector. If it's classified as thematic, it is you're getting exposed to a diversified equity portfolio, not necessarily bunched up in one particular sector and not linked to one particular sectoral outlook. But again, it is a theme that has come up over the last few years. You really have to wait and see. There is a lot of research and data suggesting that they will do well, because essentially you're buying into well-governed companies. But again, you really want to limit your exposure to such themes. I personally would not allocate more than 10% to one, if a thematic portfolio, if you have one, and stick to diversified equity funds as core of your long-term equity allocation.
Right. So as a matter of fact, ESG funds can also be categorized as flexi cap funds because they are investing across large cap, multi cap, mid and small cap stocks. And even right now, if one has to look at investing in ESG funds, so it's important to also look into the stock basket, stock portfolio that the fund is holding, and how expensive or cheap compared to historical standard it is. So this also could be one of the bases to look at investing in ESG. And definitely in the long term, ESG as a theme would do very well. But as we do understand that investing at right prices also matters. Even if something is really good, investing in some good businesses, some good things at a higher price will result in poor returns going forward. Oh, okay. So we have one question from Mr. Ashok Kumar Sharma. Should we invest in cryptocurrency? Can we invest in mining also?
Yeah, unfortunately, I'm one of those people who do not understand cryptocurrency that well. And my simple rule of thumb is invest in places that you understand. I really, just the way the value fluctuates, it seems to be driven by perception value than anything underlying on fundamental basis. I have personally stayed away from cryptocurrency. I will always advise people not to invest in cryptocurrency. See, there is a technology platform that is evolving, which can be used in multiple bases. That is fine, the blockchain technology. But cryptocurrencies per se, I'm not sure you should be exposing yourself to cryptocurrency. Again, that is my personal bias. My simple rule of thumb is invest in places that you understand, and invest in places whose price fluctuations you understand. You understand why it is going up or why it is going down. In cryptocurrency, I have no idea what drives the pricing of these currencies apart from perception value. My advice is no. I don't know if Truemind has any view on this.
No, as a matter of fact, we haven't come across anyone who can tell how to value cryptos. And I mean, we also, have the similar view on crypto. If we do not understand it, how to value it, why it will go up or go down, we should stay away from it. I think that was the last question. So we can, we can just end this session now. Thank you, everyone. Thanks for joining in. A special thanks to Nilesh for taking out his time and giving us very valuable insights and information, and had a very balanced and enlightening presentation. Thank you, Nilesh, again. And thanks everyone to you for taking out your time to attend this presentation. Take care and have a wonderful day and stay safe.
Yeah, and thank you so much to Truemind for inviting me on their platform to present. It's been a pleasant session so far. And if you have any further queries, you can always get in touch with Truemind or us. Happy to engage. Thank you so much.
Thanks a lot. Bye.